So what is break even? It's pretty much a point at which the sale level of operating income is zero. So your sales have to be above a break-even point in order to make a profit. If they're below, it results in a loss. And again, your total revenues equal your total expenses. So why is it important? Well, one reason is that businesses don't want to operate at a loss. And it helps managers determine how many units they need to sell just to make a profit. 3 ways in order to calculate break-even. You have the income statement approach and 2 shortcut approaches. One of them uses the unit contribution margin and the other uses the contribution margin ratio. And so we're going to take a look at the income statement approach. So the income statement approach starts with the contribution margin income statement, and then it breaks it down into smaller components. So this can be checked by using the contribution margin income statement by plugging all of your numbers back in and subtracting your sales minus your variable expenses minus your fixed expenses, and leads you to a break-even point or your net income of 0.
So we're working for a beach ball manufacturer, and he comes to us wanting to know how much units he needs to make in order to break even with a beach ball. So the sales per beach ball is $20. His variable expenses per beach ball is $12. Taking the sales price minus the variable expenses equals $8 of profit per beach ball that he made. And he gives us $150,000 of fixed expenses. Now we're going to calculate how many units he needs to break even by using the income statement approach. Let's do the math here. So we're going to take our sales price, which is $20, times the units that we need to make, minus our variable expenses of $12, minusing our fixed expenses of $150,000, equaling our operating income, which is 0. So we're going to take $150,000, add it to both sides, leaving us with 20x minus 12x, 150. Taking these two together leaves us with 8x, which is our contribution margin of $150,000 of our fixed expenses, dividing 8 on both sides, leaving us with 18,750 units in order to break even.
The shortcut approach using the unit contribution margin. And managers prefer to use this shortcut formula because it saves time. So the shortcut approach using the unit contribution margin starts with the contribution margin income statement, and then it rearranges some terms. Managers prefer to use a shortcut formula.
Alright, so the second approach to finding the break-even units is the shortcut approach using contribution margin per unit. Again, we have our beach balls selling for $20. We have our variable expenses at $12. Take your sales minus your variable expenses, leaves us with $8 of profit. And again, our $150,000 of fixed expenses. Now we're going to take all of this and plug it in to the shortcut approach equation. So we're going to have our fixed expenses at $150,000 plus our net income, which is we want as 0 from break even, divided by the contribution margin per unit, which is going to be our $8. So you're going to take $150,000 divided by 8, which leaves us with 18,750 units. Manufacturer needs to make in order to break even.
The next approach is going to be another shortcut, but using the contribution margin ratio. Most companies use this when they have thousands of products that they need to sell. So multi-product companies usually use the terms of sales revenues in dollars instead of the unit contribution margin. Here are some examples.
The third approach is going to be another shortcut approach, but using the contribution margin ratio. So again, we're selling beach balls at $20 per unit. our variable expenses at $12, taking our sales minus our variable expenses, leaving us with $8 of profit, and our fixed expenses at $150,000. So this approach uses percentages. So in order to find the percentages using in this equation, our sales is always going to be 100%. In order to find the percentage for variable expenses, we are taking $12 divided by 20, which leaves us at 60%. And for the contribution margin, taking $8 divided by 20 leaves us with 40%. Or taking 100% minus 60% equals 40%. Take our percentage and plug it into this equation. So we have $150,000 of fixed expenses plus our net income of 0 divided by 40%, which gives us $375,000 and tells us our sales in dollars. So in order for our beach ball manufacturer to stay afloat, he needs to create at least 18,750 beach balls or have a sales of $375,000 in order for his revenues to equal out his expenses.